It's the Black Real Estate Dialogue. Tune in. Tune in. Tune in. Tune in.
Hi, everyone. Welcome to another episode of the Black Real Estate Dialogue podcast. Before we jump in, if you're on YouTube, make sure you like, make sure you share, subscribe. Helps us out a lot, helps us get seen by more people. If you're on the audio side, make sure you subscribe on whichever platform you're listening to this on. Also, leave us a 5-star rating and review. It takes less than 10 seconds, and I can't wait to hear from you. Before I get into the introduction of our great guest today, I got to shout out my guy, Josh Foster, for making this introduction. You're the man, Josh. Appreciate you, man.
You are the man, Jack.
All right. So today with me, I have Trevor Fay out of LA. Trevor, man, thank you so much for jumping on the show. How you feeling today?
Thanks, man. I feel great. I feel good. I'm ready to have a good conversation.
Love it, man. So before we jump in, let the people know who you are, your background, and what you've done within real estate and what you do now.
Okay. So from LA, an actual LA native, one of those rare ones, that left and came back. So I'll start from college and go real quick because pre-business school was all impact stuff. So I was at Oslo College. I worked with community organizers who helped train Obama. I did a fellowship in the state legislature of California, so passed bills into law, or helped pass bills into law. Fulbright scholarship in Brazil. I also lived a bit in China doing some research there. Then did 2 years at a nonprofit, decided to go to business school to learn finance, and then pension fund, CalPERS, the biggest pension fund in the United States, hedge fund to fund internship at Grosvenor, and then ultimately decided that real estate was the place I wanted to be, and got a start in brokerage, commercial brokerage, so $50 million plus buildings for office buildings. Did consulting. Then I did private equity for a few years, and I ended up as a COO as a developer, at a minority-owned developer. And now I have my own startup that's changing the capital markets.
You've done a lot.
A little bit.
Love it. So talk to us about Kopa, the company. Talk to us about what it is and how it got started.
Yeah. So when I was in Brazil doing my Fulbright, I was a professor at a university in a very rural part of Brazil, but I found a place that I fell in love with, that I wanted to do a lot of good work in, where most of the population is Black, 85% Black. It's 4 million people. It was the first capital of Brazil, and it also needs a lot of economic help. And I was like, I want to come back one day and find a way to make that happen. And so ever since 2011, I've been trying to figure out a way to do that. So going to business school was part of that plan. Understand that real estate was a thing that was actually people could feel and touch was part of that plan. And then all the experience that I had, and it's about $2.5 billion of experience in real estate in the 7 years since I've been out. That was all with the idea of how do you take that knowledge and take it back to this particular place in Brazil, Salvador da Bahia. It's where my heart is. How do you take that back to Brazil and do something that's going to really change the world? The longer term idea of as I was progressing within real estate, I started realizing whether it was private equity, whether it was consulting, brokerage, or development, it doesn't matter who owns the property. The capital markets will dictate what you build. So if you're in downtown LA, you're going to be building condos and apartments and hotel rooms. Or, I mean, you could have built office, but no one's building office anymore. But I also realized that around the world, there's places that are actually very valuable, that are, you could call it your Compton or your Watts in LA, or there's a lot of other neighborhoods, though that don't get as much investment, that typically get gentrified out. And also that's to do with the capital markets. People with capital go into places where they don't. And so the thought process was either keep on developing and building more stuff that everyone else would be able to use, or change the capital market and make the capital market more democratic and more participatory. So had this idea to turn the real estate market, or real estate, into essentially like a dividend stock that throws off cash, let anyone invest in it, and make a marketplace like a stock exchange, like the New York Stock Exchange, but for real estate, where anyone can buy in for as low as $5, and use regular economics to actually make the capital markets more fair, and let people who've never been able to invest in real estate now be able to get income in their pocket every quarter, just like you would with a bank account.
Got you. Love it. So I know there's a team behind you that's helping to put things together. Can you talk a bit more about just the team and what different folks do and their experience they're bringing to the table?
Yeah. So while it might sound simple, put real estate, marketplace, no problem. it's actually very difficult to figure out how to actually make it work well, how to structure it well so that the sponsors, the people that are putting their properties on, don't get hurt, that the investors don't get hurt, and that everything's fair. And that's just the real estate side. So my team has over $10 billion of experience in real estate, but that's just the real estate folks. Then you have to build an actual product. So when you get onto Amazon, you think about when you start scrolling to buy something, there are teams of people, dozens of people that work on every single image you see, where it's placed, why, what color. So that's product in tech. So we have product managers and a chief product officer and product managers who actually really understand how to make what you're looking at pop and make it easy to understand, so we don't get left behind with a bunch of crazy esoteric like long form content, right? We need to have a lot better, clear, good user experience. So we have great product managers, we have designers, and then also to make it possible to do these trades for $5, you need to be able to move money for very cheap. So if you think of a regular ACH, when you go to your bank account now, you're talking about 15 cents per transfer at best. When you're talking about, so we decided to use blockchain to actually make it a much cheaper. So it's now 0.0002 cents for 10,000 transactions as opposed to 15 cents per transaction. So now when people get their money back in their pocket, which means we need to have a lot of very good developers as well, right? So we have to make sure that, and by developers, not real estate developers, tech developers. So our CTO is out of Twitter. He actually helped keep the site going, so he understands how all that stuff works. And it takes a full collaborative effort, of course. And there's also marketing and demand to make sure that we're actually finding the right people that want to get to their properties, get those on, and then also be able to invest and actually get to see wealth and generational wealth in their lifetime.
Got you. So it's basically a platform. Well, of course, like the company will have the properties, and me as a everyday person, I can invest for, let's say, a share of said property.
Yep.
Basically.
Exactly. And this property, the way that we're starting, it's only cash flowing stuff. But we don't say, hopefully in 7 years you'll get paid off and get some crazy returns. We don't want to do that. We're very much focused on how can we get you money in your pocket so that when you have a stabilized cash flowing building, that cash flow is income to you, and you get your same percentage by buying in. You get that same percentage back in your pocket. So you're a true owner for once. It's not this idea of hopefully one day it comes back.
Got you. So let's talk more about how it'll be structured. So you said $5, but let's say someone puts in $100. What type of, based on the asset you have now, like what does that look like for them as far as like, payouts and things of that nature? Yeah.
So what we do is we focus on cash flow first. That's our number one thing. So what we can do is we can look at how a property has performed, and we show you as an investor, this is what it's done. So whether it's an apartment, or it could be an office building, it could be your favorite bar or your restaurant. It could be anything. You can look at it and say, I think this makes sense. I like this story, and I look at the financials, and wow, I can see that what it's come back to me as. So from that, then you say, okay, I want to make an investment. So let's say it's $100 or $1,000. We have $5 as a minimum, but we can go to tens of thousands if you want to. You put your money in. We then say, here's your. So if you put in, let's say it was $1,000 that was on Kopa in total, and you put in $100, you would own 10% of whatever Kopa owned. So so essentially whatever comes back would be that percentage back to your bank account, essentially to your wallet every quarter.
Got you. That makes sense. So just to recap, so like if it was $1,000 building and I paid $100, I would own 10%, and the payouts I receive quarterly would align with that. Exactly. The ownership. Okay, got you.
Exactly. So it is literally like for like. It's not saying I hope let's hope that in 7 years it is worth more. Yeah. It's like typically think of almost like if it was $1 million building, Kopa took $100,000 worth. And you put in $1,000 or $10 or $100, you would get that same percentage of the $100,000. And so whenever the landlord makes a profit, you also make a profit, and that comes back to your bank account. And and whatever amount you bought in at, that's what your dividend is.
Got you. That makes sense. So I think it's an interesting structure because there have been similar type of companies who have raised money first, then invested. What's your thoughts on doing it that way versus having an asset and letting people participate in something that's already performing?
Yeah. So typically what I've seen in the private equity space and development as well is that people want to get the biggest assets they possibly can. They want to raise as much money as they possibly can, put that to work, and then charge a fee on that for the next 5, 7, 10 years if it's a fund, or 3 years to 10 years if it's a development. And that works for some people. But typically that means that if you're an average person and you want to have access to being able to trade your money out, you're not going to, like, no one's going to be buying an unfinished development from you anytime soon. And if they do, they're not going to buy it from you for what you paid for it. So that could hurt a lot of retail investors. And that's what we ultimately don't want to do. We want to say, hey, look, you make money because the building does well, and you get to compound it over time, and that's how you build real wealth. And so our thought process is, let's let landlords stay in the building. They sell us a partial share. We then take that partial share and then we give it out to everyone else. And we have an appraiser then value that, right? So it's not based on us. It's not based on the landlord. It's based on what the actual value of the building is. And then everyone gets to do well. So the landlord still owns some. So when a bunch of people buy in, the property value might go up because there's a lot more people that can actually have access to the real estate for once. That means that everyone that's in gets to go up as well. The other thing that happens is that the community for the first time is able to invest nearby. So it's a very different model where, because you know there's value in your community, you can invest first, but also because it's on blockchain, it's international. So we could actually have people from Dubai or Thailand or or Lagos in Nigeria be able to invest, and and everyone's side by side with each other. So because there's so many more people that can put in, now you get a chance to see your value go up, and you can see the value in your community go up without having to have any gentrification.
That makes a lot of sense. So is the vision eventually for, like, let's say I'm a real estate investor, I have this $500 mixed use office, residential. Would I put it on the platform to get more investors for it? Is that how ultimately it'll work out?
Yeah. So think of let's say you had $1 million building or a $10 million building, whatever. And you said, I want, let's say if it was the same $1 million building for ease, you say, I want $100,000. And I need that because I want to either do some kind of improvement that'll make the property better off, or I want to go on a vacation. It doesn't matter. What we look at is we say, what's the property been able to do? What's the cash flow from it? And then we say, cool. And then we have an appraiser appraise it, and we say, this is what the value is. And it's very basic. And then for that amount, and they say it's worth $1 million, cool. We take 10% of the ownership. It's very simple. Then from there, anyone that buys into that structure. So essentially, we don't as Kopa, all we do is take a management fee that's very transparent. We don't do anything else. So for you, you know that you're getting some cash flowing assets, and that's going to grow over time. And you get to buy in for whatever it is that you want to. So you could put in $500 or whatever you like.
Got you. So ultimately it sounds like it's a platform where you're helping the developer or investor find a market of people who can contribute capital to whatever it is they're trying to do with the asset, more or less. And for that, I mean, obviously you need to be compensated. So that's kind of how you all will get paid.
Yeah. So
for helping to facilitate.
Yeah. So we just think of that. We'd have a max of 2%, and then we go down from there, but a max of 2%.
Ownership?
Oh, no, of a fee. So
okay,
management fees is a max of 2%. There's a lot of platforms out there that are charging 8 and 10.
Wait, what?
Yeah. There's a lot of platforms out there charging 8 and 10, and it's not even off of the net, which would be like the profit of the building. It's off of the rents itself, the gross. So it's actually much more expensive to have a lot of these other platforms. So we keep ours low, and we keep ours very steady. And like I said, we go 2% and lower because we want you to actually be able to own the real estate. We don't want to talk like we're about democratization and then not actually do it. We want the word Kopa actually means active participation in Yoruba, in Nigerian. We want to make sure that it's actually like everyone gets a chance to win, and then we all get a chance to grow. So when we take our fee out, it's only because the properties have been performing. If the properties don't perform, we don't take a fee.
Got you. Is the fact that this is facilitated on blockchain, does that enable you to lower the fee you take?
A whole lot, yeah. So I think if we weren't using blockchain, it could be thousands of times more expensive just to move any money. And so we're not using blockchain as like one of those rah, this is great, look at us, we're so cool, hype. We're using it because it works. When you go onto E-Trade or Fidelity or Robinhood, what computer systems are you using to trade your money?
I don't know.
That's what there's a bunch of centralized computer systems somewhere that they all own.
Yeah.
Same thing with blockchain.
Yeah.
That's how we're going to use it. It's like it's a way for you to get your money out cheaper, faster, better, and it's all in dollars. So it's not like it's a real problem.
Got you. So I have no idea. Like talking to you a couple weeks ago gave me some more insight to the blockchain, how that works.
Yep.
I don't really know much about it. I'm assuming a lot of listeners may be in a similar situation.
Yep.
So just to recap for those who are listening, basically I can invest in a property on Kopa's platform and it's facilitated through the blockchain. So let's talk about the blockchain. What does that even mean? And talk more about like the benefits. I know you talked about lower fees, but what is the blockchain and how does it help in this situation?
Yeah. So it's really just like a computer system. At the very end of the day, just think of it as like a big computer system. So if you're on Facebook, you're on their computer system. If you're on Amazon, you're on their computer system. People have heard about AWS perhaps, or Microsoft has their computer system. Blockchain is a large computer system that's owned by no one. And so for that reason, it's a lot more scalable. There's no one company that can turn you off. There's no one company that says, here's what you have to do. But on the flip side, the fees are very transparent and they're much, much lower because you have a lot of different nodes that are now working together to make this computation work. And all you need when you're doing computation is, in terms of money transferring, can I move money from here to here? That's it. So either you could pay for Amazon to do it, and they're going to upcharge you. You can pay for Facebook to do it. They're going to upcharge you. If you have to use a money transfer system like an ACH, or a wire can cost you $20-$30. An ACH can be, like I said, as low as 15 cents. But blockchain, because it does so much more and it's a lot more efficient, can do it for 0.0001 cent, right? So if you actually invested $5, all of your return would go to the fee, to the ACH fee. Whereas with us, we're going to make sure that you can there'll be money in your pocket, even if it's $5 worth. So for us, it's a really good use of a technology that makes things a lot more efficient and simpler. And the best thing about blockchains is that, like, the ACH system has no real incentive to upgrade, right? They've been doing this for a long time. They know what they have works. Their fees are their fees. They'll stay. Blockchain always is trying to get cheaper. It's always trying to get better. It's always more developers are always trying to get it to come the price down even more, which of course allows for us to then pass those savings on to our investors.
Got you. So it sounds like the blockchain lowers your cost and it also lowers the cost for investors.
Yep.
And enabling them to invest with smaller amounts of money because they're not being charged so many fees.
Exactly.
Got it.
And it's just a big scalable computer system.
Got
So
it.
basically when you do it, and then of course the other side of it is blockchain is very transparent. So anything that you do, you know for sure once something's actually written in the blockchain. You'll see there's groups like FTX that have gotten in trouble for being fraudulent. There's groups like Celsius. There's groups like Terra Luna. Those are all companies that did something that was actually fraudulent as a company, but the blockchain itself has never been hacked.
Got it. That makes a lot of sense. So if I'm that person who invested like $1,000 and, I'm getting my quarterly payouts, where does it go? Does it go to my bank account? Does it go to some other system? I'm not sure. The reason I'm asking is I'm not sure like how the blockchain works. Like if it just puts it in my bank account or something.
So basically the way that we do it is we have, it would go to your wallet, your crypto wallet. So the way that it works is there's this coin called US dollar coin, which is 1-to-1 with the dollar. It's 0.99999 cents to a dollar. And then sometimes it's a 1.0001, but it's basically a dollar. That's the faster, easier way of being able to transfer the money. That's why this blockchain works. But the money that you get in your account is a dollar. It's the equivalent of a dollar. You can then take that and trade that for a dollar in your bank account. But the way that it makes it much cheaper for transferring the money, it goes from the real estate, from our account, transfers out to you. It goes into your wallet, and then you change that. You can take that and reinvest it into real estate, or you can take it and transfer it for dollars, take it out. Up to you.
Got it. Is the fee still low? Like transferring from the wallet to the bank account?
Oh, that's the fee I was talking about.
Oh, that's the fee we've been talking about.
Yeah.
Oh, got you. I understand.
Yeah.
I understand. Okay. Cool. So as far as like security, somebody might say, oh, well, what is in my wallet? What what if something happens before I can transfer to my bank account? So, I mean, because with the banking system, right? They secure 250,000, et cetera.
Yep.
How do you address that?
Yeah. So when you have your own wallet, well, Copa, we don't actually store the wallets ourselves because we'd be a very large target for someone to try to steal from. So what we do instead is we say we give you a wallet, and it's your own wallet. We don't have any control. We don't know anything about it. You've got your own security around it. No one's hacking your wallet otherwise. And then whenever you decide that you want to take it and put that into your savings account, then that's essentially you transfer to US dollars, you put in your savings account. That's your savings account, just like it would be at the bank. It is at the bank, right? It's at whatever bank you have. So for us, we just use the blockchain to get the money to you cheaply.
Gotcha.
But for you, you can take it, switch in dollars, and then take it out and do whatever you want with it.
Got it. That's really very interesting. It's a very interesting model.
And the other thing we're gonna do is I didn't mention, and we should have done that before. When I was in Brazil, I was a professor, or I was a help teach at universities, and I don't want anyone left behind by this. And so we have a lot of free education, and we're gonna make sure that people understand how to do it. So it's not like you get on, okay, great, I have this digital money. What do I do with it now? We actually are going to have actual videos explaining how to do it, how to get your money out, how to transfer it, so that you feel very safe. Our number one thing is we want everyone that's on to be able to invest with confidence. And to do that, we have to do a lot of free education to make sure that people feel comfortable.
Yeah, no, I appreciate that though, because a lot of people don't approach it that way. Like they might have a fund or, an investment opportunity but they don't want to be transparent with people about like what they're making, how they make money, how the whole process works, what all the fees are. Like a lot of times with a lot of these other platforms, it's like kind of underhanded stuff in the fine print. Whereas right here, we're just putting it all out.
Exactly.
You know what I'm saying? And, I think that's important to be transparent, because there's not enough of that in that part of the industry, when as it relates to like different funds and platforms and things like that.
I could not agree more. I think that the more you want to hide something, the more there's something that's wrong with how you're doing it. And from my experience and seeing lots of other groups, a manager's job is not to make you money necessarily. A manager's job is to make themselves money, and then for the cheapest amount they can give it to you. We're not that. Right. That's why we're a platform. That's why we're not doing the deals ourselves. We're not trying to. Our stuff is transparent because it's actually easier and better for us to be aligned with who we are as people. We want to see the world be better off. We want to see people be able to grow their wealth, and we want people to feel it. Right. This is about ownership. This is not just it's not pie in the sky stuff. If you feel like you can own the world beneath your feet, then you can do anything else. If you feel like you can own the world in Paris, you can own your world in Africa, you can own your whatever, you can do that, right? Our job is to make sure that you know what you're doing, you know what you're getting yourself into, and essentially give you all the free education so that you can. And if there's a question that people have, they then come back to us and we'll make more information available, because it's literally in our interest to make sure that people do well. And the business model that we have is also not about getting people in the short term and then seeing like, okay, well, we got you, now we got your money, whatever. No. Our business model is we're going to be here for the next 100 years, right? We actually want to make this scale and be worldwide, and we can't do that by and focus on volume. We don't do that by being small-minded and saying we're going to be here today, gone tomorrow, kind of thing.
Definitely, I appreciate that. So something I want to get your take on. How do people evaluate investing in like real estate fund, whether it's with Kopa or a different platform? Like, what are some of the things people should be looking at so they can make an informed decision?
Yeah. So I think high level is first of all, what's the structure itself? So you said funds. There's real estate funds that will essentially be commingled, which will take a bunch of different assets. You give someone some money, they'll go find a bunch of assets and do it. Or you can buy an individual asset, right? One at a time. With Kopa, we only do individual assets. We don't do funds, because what typically happens on top of that is the more complex the fund, the structure gets, the more ways someone can charge you fees, right? And that's the real thing that you need to worry about, are fees. So if you do any real investor has to have investment terms in their legal documents. Do a control F and look for all the different ways they charge you fees or expenses. You put those put those in, they can't hide them. So You can see acquisition fees, disposition fees, construction fees, management fees, property management fees. You find out, first of all, what's the total amount? What's your total fee load? Which is actually a big deal, because when people say, oh, yeah, we can charge you a fee for this, but they actually might charge you 3 or 4 different ways because they have an affiliated entity that owns like the property management, for instance. That happens a lot with REITs. You want to see what the total amount is. You want to see who owns that total amount, and you want to see what's their incentive to work in your favor. If they have an incentive to get their bonuses by doing a lot of deals because they're charging you a 1% management fee as an investor, then they're going to do as many deals as they possibly can. Whereas if you say very clearly, this is what I want you to, this is the box. I want this deal, this place, then it's something different. So high level, number one, no matter what you do, look at the fees, look at the structure. Number two, you look at the property itself and then its ability to actually make money. So is the property in a good place geographically? Is it in a place, does the use actually match what the geography says? So if you're in downtown LA and you want to put it in an industrial place, that's probably not going to be the best use of land, right? You might be able to get good rents, but you might want to do something else different with it. So what you want to start thinking about is, all right, so right now, either this thing does make money and it does make rent and there is someone paying rent, or it doesn't, and they're hoping at some point someone will want to pay rent. Put yourself in the tenant's shoes. Would I want to pay that? Would I want to pay it at that price? Does that make sense? And then you can look at other comps in the market and say, okay, did that pan out? Are other people paying that? But all those things, essentially, at the top level, you've got rents, and rents are pretty straightforward. So either someone's going to pay what you asked them to pay, or they're not. And then from there, how many expenses, like, do they run the property well? Are the expenses, like, do the expenses allow there to be a good NOI or net operating income? And then once you have that, you say, okay, well, based on that, that's the property itself. Now I've got fees. How much are they taking out of me? If I know that someone's taking 8% or 10% off of the rents before that even gets to the fees, then I'm going to lose a whole lot more, even if the property does a little bit better. Or will this other group charge me less, and then I get something that's more consistent? So I think you want to look at it from a property level. You want to look at it at the fund level. You want to look at it from the management level. Are they able to actually execute on the plan? And then you see, does all that make sense to you? Does what they're selling you make sense? Are they saying that, or are they saying that, honestly, we don't even know if it's going to, we hope it does well, but we're not going to find out until year 7 when we sell it. Do you trust these people to hold your asset, hold your money where you can't get it out for 7 years? Because if they say that they're going to get no cash flow for the first 3-4 years, and then in year 7, they pop up saying, oh yeah, we weren't able to sell it for what we thought we were, so we didn't get as much of a return as we thought we were going to get. But you've been paying a management fee for the last 7 years and property management fees for the last 7 years. They've already done well, right? And that's an economic calculus that a lot of people don't realize that managers are making. It's about how much can they get from you through the entire time, and then if you do really well, then they get something on the back end too.
That was a great breakdown. So it sounds like if anyone wants to invest in real estate through a particular online platform that buys properties or whatever the case is, we should look at all of the fees that are going to be charged, when they're going to be charged, as opposed to just looking at whatever return they promise. Like, there's a lot of the details in the documentation that most people probably don't look at.
Yep.
That we need to make sure we're looking at to make an educated decision.
Exactly. And I'll even say there's a step beyond that. What a lot of companies will do is put a very high looking return, a high IRR. And you think, oh yeah, 17%, that's a great deal, right? But there's a bunch of assumptions that have to go into that, right? So you're essentially going to assume expense growth and rent growth. Well, if you're in a market where there's been 2% rent growth for the last 10 years, and someone says that they're going to make 6% rent growth for the next 10 years, do you believe that? Because if you do, then maybe that's a good deal. But if someone's trying to sell you on that, oh yeah, this thing is going to grow like at a rate it never has before, and I have no basis for that, but I know that when I sell the deal, that IRR goes up quite a lot, and it looks really good for me. And oh look, unfortunately, the rent only went up 2% every year because the market doesn't care what the underwriting says. But at the end of the day, You get to year 7, and you're like, oh yeah, it looks like we're not going to be able to. We have to build a cap rate on our NOI, and our NOI has only gone up by 2% a year. It hasn't gone up by 6. You've paid us our fees, so we're good. But a lot of these platforms will put a number there and make it seem like it's like anything forward looking is risky. So they'll put a number there and make it seem like it's like in the sand, like like a line in the sand, and it's not. It's the best they can get you to believe, so that you give them their money.
Definitely. A couple of vocabulary words for people who may not know. What is IRR?
Internal rate of return.
What's like a basic definition of that?
I won't go into the academic version. It's really just if you put in your money at any given amount, and you wait 7 years or however long you want to take to get your money back, that's how much. And all the assumptions are true and everything comes true. If you hear an IRR of 5, that means that you would have made by the end of it 5% a year on average. You might you'll lose some because you put the money as an investment. It should be paying back over some time, and then you sell, right? And IRR takes all that into account, all the cash flows, all the different ways that you put money out and then put money back in to say what your total amount will be. And it's just an internal rate of return that calculates that. So generally, you can use an apples to apples comparison with IRR in real estate or private equity or venture capital. They all have IRRs. It's a way of normalizing it if you want to look at different investment types. But the problem, of course, is what are the assumptions? If you put garbage in, you get garbage out.
Makes sense. And then what about NOI?
Net operating income. So essentially, if you think of a building as a business has to make money. Business also has expenses to be able to pay. You need to pay a certain money to make the money, and after that, you get your operating profit, right? That's what your NOI is. So if you think of your electricity, if you think of your garbage, your sewage, whatever, those are all expenses that you have to pay. Otherwise, the building wouldn't make any money because it would be a cesspool, right? So take the amount you can make, subtract the operating expenses, and then you have your net operating income. And that's what typically is used for what's called a cap rate to determine what the value of the property is. And that's essentially, it's an inverse of a multiple. But the easiest way of saying it is like if you were to put $100 in and it's a 4% cap rate, that would mean that you essentially should be expecting about 4% back a year on that money.
Gotcha.
Typically, cap rates, the lower the cap rate, the safer your asset is supposed to be. But in reality, what it is the lower a cap rate, the closer it is to people that are wealthy.
Yeah. Makes sense. And then underwriting. What is underwriting?
Underwriting is looking at the deal itself. So if someone comes up to you and says, hey, I got like in Jack and the Magic Beanstalk, if someone says, I got these magic beans for you, and Jack just buys them off the bat, right? He's just like, oh, that's cool. I put them in the ground and see if they work. He didn't do any underwriting. He didn't actually see that, okay, put them in the ground. Let me see if it actually grows, right? He just said, I'll take them all. And I put them in the ground, right? That's the opposite of underwriting. That's like, oh, you told me something? Oh, that sounds great. I'm just going to go do that, right? Whereas you have to look at the building itself and say, someone else says this thing can do X, Y, Z. That's great. But their belief is not my belief. So if they believe it's worth something, that's great. Show me how the actual building looks, how it operates, the tenants that are currently in there. Let me verify that for myself based on what I believe. And if I do that well, then I have my own expectation of what the returns might be. And now it's based on what I believe. It's not based on what somebody else does. And that's the difference that oftentimes gets lost in real estate. Because if you do a bad job at underwriting, you could believe somebody else's stuff, and they have an incentive to overinflate so they can get more money from you.
Gotcha. So basically underwriting is like verifying all the facts of the deal, verifying that, whoever's selling the property, for example, what they're saying is actually true. There's
that. And there's also underwriting the assumptions, right? So if we talked about the 2% growth versus the 6% growth,
yeah,
you would have to look and say, well, does 6% make sense, right? Because that's not, you can't look at the property itself. That's on their projections of the future. Mm-hmm. So if you believe that, then that's also part of your underwriting to say you're verifying those things as well. So you're verifying the building itself. If someone says that they're going to take an office building and convert it to an apartment building, and they have everything checked off, right? And the city is going to let them rezone it. Cool. If you were underwriting it, you would go talk to the people at the city to find out, is this actually approved? And if they say it's not, well, that's why you could figure out that building may not be worth what the person says it is, because they're lying to you. So it's like trust but verify, right? You want to verify literally everything so that when you make an investment, you make one informed for yourself.
Got it. That makes sense. So Kopa, y'all have purchased a property to start,
Yep.
to prove the concept.
Yep.
So we'd love to hear more about that, what you were looking for when purchasing this property, and, once the launch happens, like what's the plan to integrate everything and hit the ground running?
Yeah. So we purchased our first share of a property, not the whole thing, right?
Gotcha,
Because we
okay.
want to make sure that the owner stays in. And what we wanted to do was something that was relatable, that people actually could, again, see, feel, touch, and understand. So this building's in Sacramento, California. It is for executive housing. So think of like your traveling nurses. That's a big thing. Or if you're
Everybody's talking about that now.
exactly. So we have, and it's furnished, so people can come in. There's business people that come in. It's at least for a month. So it's at least a month of rent. It's much higher. It's higher than the market rate or it's higher than what you would get for a regular apartment because it's furnished and everything is kind of handled, and people just go there to sleep at night essentially. And then there's 4 units of that at the top, 5 units of retail on the bottom. So there's a custom eyeglass studio, like actual glasses. There's Pilates.
I need to go there.
Yeah, no, seriously. I do too. I wear contacts, and I might. They have the good stuff. There's a Pilates studio, right? There's a general store. So it's on a main street in Sacramento where there's actually like there's every month there's an actual like a natural street fair, right? That happens all the time. So it's a place and of course, because of that, people can see that Kopa's done it from the street, right? And so what we did is by purchasing that piece, we're now going to once we launch the full platform, which of course requires all the stuff with the SEC and securities law, make sure everything's safe and good, and that we're doing through all that stuff now and building the full product. Once that's launched in a couple months, people will then have the option to be able to buy into that, and we're shooting to have like 4 or 5 properties on by the time we launch. So there's some options. But what's also really fun is, again, this is not just about real estate. This is about getting people to feel different, to think different, to join a movement of a different way of doing things. And so in the next couple of weeks, we're going to be launching this waitlist challenge, essentially, that lets people log in and then share what it is that they want to own around the world, right? They get and say, I want to own this cafe because this is dope, or I want to own this bar, I want to own this restaurant, I want to own this mall, I want to own the Eiffel Tower. We don't care. Take a picture of it, take a video of it, and then you'll have your own individual link. You can share out to people and refer them to come onto the list. But you also get to see some of the coolest shots from people around the world, like what they want to be able to own and become part of this movement. And those that are highest up on that list will be able to be the first to be able to invest. So we're gonna make sure that people that are doing things about spreading the movement and growing are the same things that are the people that get rewarded to be able to invest first.
Love it. So is the goal? So I know. So is the goal for people to be able to purchase some of those shares? Like, so y'all have a certain, I guess, percentage that'll be available to the public to invest in.
Yep, exactly.
Gotcha.
Yeah. So and again, our platform is not designed to like be the landlord ourselves. So we want to literally take it. We're going to share it with everyone, right?
Gotcha. Yeah.
Yeah. So the landlords or the people that own the property are top notch, amazing people. I've known one for over 10 years. So like I'm confident. I know that he not just does a good job, but also I know the story of the building. But yeah, no, for us, it's much more about how do we get this out to more people. And the other properties that we're putting on are also going to be of that same type. We're looking at doing a workforce housing in Virginia as our second property. And there's some other stuff in multifamily stuff in LA so that we could let people start being able to invest in. And then after a certain point, when people start saying, oh, I want to be able to own this or own that, then we'll know that. And we'll start finding people that actually own those things and say, hey, look, there's a lot of interest for what you do and you're not going to lose your property. So, because they're only taking a partial share and they still get to have full control. Hey, look, maybe you want to put some of this on and let the community participate. Because at the end of the day, the other thing that matters too is if you think of something like a mall. If you own part of a mall and a mall is set up with leases that essentially if you're in a store and you make above a certain amount, that goes back to the landlord. Well, if you're the landlord, then where are you going to start going with your free time? You're gonna if you're picking between 2 malls, you're going to the one that you own. And as more people do that in the community, now the mall becomes more valuable because there's more people that are there. And now the best stores want to follow where it is that the people are going. So we talk about black dollars and black consumption dollars. how would you feel like if you could actually go into a place and actually get the benefit from actually putting your money in?
Yeah.
Right. So it's an entirely different concept, and we want people to start thinking that way as owners. I want to see little kids walking around being like, I want to own that one and that one and that one, and start thinking about themselves like, well, I want to be able to do things that are different. I want people to look at the news when you see stuff that's happening around the world and go like, oh, wait, that actually affects my property. Oh wait, let me think about, whoa. And now it's no longer that the news is happening to others. Now it's like, no, this is happening. This is me. And you realize that as humans, we're actually all very similar, right? So we want to spark that movement, and this wait list is a way to start. And then of course these best properties, because these are great properties. We want to put those to kind of get that. We want to kick that off, right? And get those and get the best people into those. And then essentially it's going to also be on a secondary market. So if they ever need to be able to sell, they can do that as well.
Got you. So it sounds like, of course, like people making some income and stuff is one of the goals, but the other idea is kind of at a higher level. So if you have, let's say, LA, for example, you had 100 people who own part of this particular asset. The idea is like they'll be more incentivized to patronize the businesses there and things of that nature, and just kind of starting that cycle of the dollars flowing.
Exactly. And if you had an apartment, and imagine if you owned, a fourplex in whatever part of LA, right? Or you were a partial owner of that, and you found out there was a vacancy. Well, you know that the property's good because you bought into it, and you have a friend that's moving to LA. Where are you going to tell them to move? Right? So if you're the landlord, you've done a whole lot less than trying to wait for people to try to fill it up. You're vouched because there could be 10,000 people that own a little share of that property. You have a lot more people now saying, oh, wait, I can help someone find this, right? And now it's much more about community, because I think, especially since the pandemic, we've lost a lot of that, and we got to get that back, right? We win when we all win together.
Yeah.
So we want people that are very much part of that thinking to come through and change the game.
Definitely. And so you mentioned the secondary market, so people can basically sell their shares.
Mm-hmm.
How does that work? Because a lot of similar situations, there's like a lockup period. So there's a period of time during which you can't do anything with the money you've invested. But it sounds like if I put in $100 in January of 2024 and I want to sell in January 2025, I'm able to do that.
Yep.
Right.
That's the maximum amount of time that we would lock something up is 12 months. And that's just based on different SEC regulations. But for some of the larger deals, you'll be able to trade it right away. There's literally no lockup time. We're looking at combining a few things that have never existed before.
Yeah.
That could allow for you to literally, you buy it 1 second and sell it 2 seconds later. It's like we want people to be able to get access to money and really have a true liquid market.
Got you. That makes a lot of sense. So how do I know how much my shares are worth if I want to sell? Like, is there like some type of evaluation tool or something like that? How does that work?
Oh no, it's based on, just like if have you ever gotten like a stock market app and you see like the price moving, it's because people are always buying and selling.
Got
Right?
you.
So you're going to see what the value is right away. You can say, I don't want it. Let's say your $5 share went up to $10 in value, right? And you can say, I don't want to sell it until it gets to 11. You cannot sell it until it gets to 11. But if it goes up to 10.55 and you say, okay, actually I will sell at this point, you can do that too, right? There's no guarantee that it's going to go up to 11. There's no guarantee that it's going to go down to 9. But you have to say based on what you believe, because for the cash flow that you're getting from that value,
Yeah.
or the cash flow, the distribution that you get to your wallet every quarter, you may say, I'd rather keep this distribution at this level than sell it. Or you could say, I actually wouldn't mind selling it at this price because I've found something else that's similar, that yields something similar, and I get some appreciation on this thing.
Got it. It makes a whole lot of sense. So I have a couple things I want your opinion on.
Yeah.
So someone may be thinking, Kopa sounds great. When they launch, I'm gonna see what's going on. I'm very interested. And maybe they're weighing Kopa versus like a real estate investment trust on, one of the however many that's on the stock market.
Yep.
How would you talk to them about that?
Yeah. So first off, there's never going to be a one right answer. So you can do that and you can do both. But we're structured very differently, right? So if you think of a REIT on a public or private REITs, which, well, I won't talk about those. Let's just say public REITs. What a public REIT is a compilation of tens to hundreds of properties, right? If you think of, like, let's say Simon Property Group, which is the big mall.
SPG.
Yeah, the mall group. If you want to own a mall in, say, Columbus, Ohio, does that mean that you also want to own a mall in Miami and a mall in Minnesota and a mall in Las Vegas? If you do, great. If you don't, then you don't really have a choice, right? And then when you have a large REIT, they're always doing buying and selling deals, right? They're always doing more stuff. And they pay themselves bonuses out of that money, right? So the management fee that you pay, which could be very low, may not account for all the different. If you're talking about selling $500 million or $100 million buildings, those could be some pretty large acquisition fees and disposition fees, right? And brokerage fees to get those things done. So you're going to be paying for all that. And essentially what a REIT does, it makes you look through, if you want to understand what's really going on, you need to look through all their different assets, all the different moves that they're making, all the different offers that they're making. And there's people who literally do this as their professional jobs, right? There's also, I think, a reason why many REITs trade. If you look at the net value of all their assets, you added them all together, their stock price is below what if you took all their prices of their properties and you put them together individually. There's a reason why the actual stock price trades below that, right? And it's because people don't necessarily know if they trust the management of those REITs. And so with Kopa, you get to buy one property at a time. So if you want to own, the one in Columbus, you could do all that. Or if you want to own the one in Columbus and Las Vegas, but not the ones in Minnesota and Miami, you can do that too. So we give you choice. We're much more about choice and transparency. And then when something has come back, as opposed to this larger corporate entity telling you when you're going to get your payouts. You're going to get it because the mall itself is going to be like giving us part of of that distribution, of that income. So it's a different type of model. They're both liquid. They're both able to be traded. But for us, we don't want it to be about who can make a big deal. We want to be like, how can this thing actually work, and make it very simple and straightforward. And then, of course, because you understand what the asset is and you can go to the asset and you can see it, it's no longer this like idea of a portfolio somewhere that's like so much more difficult for people to understand. It's like, oh no, this is the one spot, right? And so if you wanted to, at the end of the day, so that Simon Property Group as an idea, that's just the malls. And let's say if you want to own residential, you want to own whatever. Like now, if you want to own all those things, you have to buy a bunch of different REITs, right? The last thing about REITs is that they have a lot more. There's limits for what they can do from like they have to throw off cash flow. They're required to do that. But there's some REITs that will change their strategy on you, and you have no idea, right? There's REITs that will say that I invest in safe Fannie and Freddie debt on multifamily properties, and then go buy some of the most expensive debt, most risky debt you can on hotel construction. And while they'll ask you to vote, are you going to be monitoring all their transactions to make sure that those are the things that are actually happening? If you're not, then you just have to understand that might be something that you're trusting the management quite a bit, and at least know who the management is.
That makes sense. So to recap, it sounds like REITs can potentially be a lot more complicated to find out exactly what they're investing in, because they're invested in like a number of assets. Mm-hmm. And as an owner of the REIT, you get paid back, but it's not because of X mall or something else. It's because of the total portfolio. Whereas with Kopa, people will be able to select individual assets they want to participate in, individual assets they want to invest in.
Exactly.
Got you. Okay.
Exactly. Yeah. And there's a lot of movements. I mean, the more complex, if you think of real estate being the asset itself, the more layers you add on top of it, and the more people that are in between you and that asset, the more likely it is, and they all have to get themselves paid, right? Mm-hmm. So they're all going to be skimming off of what the actual asset does. So the closer the asset you can get, the more direct exposure to what you actually want to invest in is that you're getting. So for us, we say, like, let's give you directly that. Let's not have a bunch of, REITs have large staffs. They all have to have bonuses. They have to get paid. The money comes from somewhere. It's coming from the investors.
Yeah, that makes a lot of sense. What if someone's weighing investing in Kopa versus like buying an investment property somewhere?
I think, again, there's not going to ever just be a right answer. With an investment property, if you're planning to do the management yourself, that is its own separate thing, and that's a lot of work, right? And there's some folks that, and also if you're doing investment property, you typically are going to buy low and improve it and then want to sell it higher. Kopa would focus on the stuff that already is performing, right? So if it was already performing, you might put that on Kopa, but we're not so much about like, I'm going to do all this extra work so they be better. So I think that that's a very good thing. I think also that you get some tax benefits from doing that if the property does well. And if you have the capital for it and you have the know-how, or if you can feel like you can get the know-how, it's a great idea. Most people don't have the ability to do all that. And again, at that point, you're concentrated, all your capital is in that one asset or however many assets you're actually working on. And with Copa, if you had $1,000, well, let's say you're doing it with a property and you want to put $100,000 down. With the first option, you're going to put all of it down to this property and get debt and be stressed as you try to manage it and grow it. The other option is with Copa, you could do 10 properties at 10,000, or you could do 100 properties at 1,000, right? And now you're very diversified, and you can get a lot of those same benefits. You may not see as much value appreciation, but also you don't have to do any work for it because someone else is already managing the property. So and you might want to do both, right? Yeah. And the whole idea for the wealth that we're trying to have Copa create for people and the generational wealth that we hope to be able to build, that is actually like the money you can use to go have the money to be able to do that down payment and get a property and rehab it and make it good, and then you can put it on Copa.
Yeah. Like it. So one of the blogs you sent me was about distressed investing, and I thought you had a very interesting take on it. So let's talk a bit more about your thoughts on distressed investing.
Yeah. So part of we said before about the free education, I'm realizing that I had to go to business school to be able to do the real estate stuff that I do now. No one would have given me a job, even as a Fulbright scholar. No one would give me a job in finance because I didn't know it. And I always hated the fact that I had to go and take on debt to be able to do that. I don't think that's fair. And so I want to make sure that anyone that wants to understand this stuff, I'm going to give them those lessons so they can do it for free. And also in doing that, when you're in B school, you're banging your head against the wall. You know, I got to learn this stuff. I got to learn this stuff. I got to learn this stuff. And you take it for a test, and then you hope to be able to use it. And most of the stuff you forget, and the stuff that you use in your day-to-day, you use. But it doesn't stick with you. It's something that if you use it, you use it. One of the things from my community organizing days, it was about how are you able to tell a story that actually fits. And so what we want to do is, what we're doing is we're creating blogs, and eventually we'll make video series for free that explain concepts that typically are very complex to people that don't understand how the game works, but use it in really simple metaphors. And so our first blog is on distressed real estate investing, or distressed investing. And it kind of lets people know this is what happens when something in the market changes. Like we've had interest rates increase a lot recently. We know that there's going to be a lot of owners that can't refi for the same amount that they thought they would be able to. And if they're in trouble for whatever reason, not through the property, but just because the money they thought they're going to be able to raise, they can't raise anymore, and they don't have any other options of people they know, they could have a very good property. But then you have a bunch of but they're not going to be able to keep the property going. So there's a bunch of people waiting on the sidelines that'll be like, "Oh, you're in trouble. I'll take that from you, but I'm not going to take it from you for the market value. I'm going to take it from you for 20 cents, 30 cents, 50 cents on the dollar." And so even though because I know the property is already valuable. And so as opposed to talking about just the pure finance of it, it's like, how can you make this more memorable? It's like, oh, if you think about it, almost like wolves going after, our metaphor is that we use wolves going after a herd of oxen, and a baby that can't keep up falls behind, and the wolves take it down. And right now, that's just what it is. There's billions, there's over $100 billion that are sitting on the sideline right now, waiting for the recession that's what's happened since the pandemic, to take from people when they were at their weakest. They're still circling, right? And they're ready to pounce. Downtown LA office is already starting to see some of it. Our job is to provide an ability to stop that and say, hey, look, the public will actually understand that there's value here, that this is a good owner, and that they didn't foresee interest rates rising, so we can be the stopgap there. So we talk about, we want to make this metaphor really clear. So you can imagine a wolf chasing, like you see the stuff on National Geographic. Now you can imagine that being like, okay, this is when someone's coming and okay, I'm a distressed investor and I'm trying to now go get the weakest of the pack or of the herd. We say, hey, no, stop that. We'll nurse the calf or the ox back to health, and then as it gets bigger, it'll help you become it'll essentially be it'll help you be a better farmer, right? To be able to go create more dividends and more distributions for you in the future. So it pays you back because you're actually doing a thing that right before now couldn't be done.
Got it. Do you think it's wrong for investors to make lowball offers to distressed sellers?
I don't think it's wrong. I think it's, if you can do it and you feel like and you're comfortable with it, I think that's an individual. I think, well, there's more than that. If you believe that what you're doing is right, I'm not here to tell someone one way or the other. If some people believe that the markets are just the markets and, someone should have been more prepared, and that's totally fair, and then before now, it's because there's only been one option. So like if you're the last option in the room, you could say whatever you want, and that's been a strategy. That has been most of what finance is, right? Now it's going to be about, well, is that there may not be the best option anymore for people. There'll be other options for people. So it's not about being wrong. It was about this is what the world is, or this is what the world was before now. Then are you gonna play the game or not play the game? I'm not about saying what's morally right or morally wrong. I'm more like, it's great, you played the game as you were supposed to, and now we're changing the game quite a bit. Again, the capital markets.
Mm-hmm. Definitely, that makes a lot of sense. So, when is the launch, and what are some future plans for Kopa that maybe we didn't touch on?
Oh, the launch should be in 2 to 3 months.
Okay.
The launch for the wait list should be in the next couple weeks. I think you've seen the music video. That's
fire.
We're excited about being able to launch that to the world.
Yeah.
So we want to start having people be able to join the wait list. We're putting out a lot of blogs now. We're also going to have a lot of social media content, so that the educational stuff that's more fun. But the full launch, we want to have a large party, likely in August, maybe September, that allows for lots of people, hundreds of people to come out, be able to celebrate together. And the full MVP, our version of MVP is actually a lot better than regular MVPs. Should be in the next, like I said, 2 to 3 months. We'll be done before then. We want to do some testing, and anyone that wants to be involved, if you want to be involved, please let us know, because we need some beta testers to make sure that everything's clear, so we can make sure this is clear and easy as possible. But yeah, this summer it's going to be a hot summer for a lot of reasons.
It sounds like it, man. It sounds like it. Where can people find you? Where can they keep up with Kopa, reach out to you, and just keep the conversation going?
Yeah, I would love that, first of all. And I'd love to hear about what people are thinking about and what some different ways they could do, they could see themselves interacting with Kopa, because again, we don't have just one vision. It's how do we make this as exclusive as we can for everyone. So our website is kopamarket.io. So Kopa, Kopa, market, market.io. And then, we have the wait list. We have a Discord, so people can actually talk with us directly. Twitter, Facebook, Instagram, all that other good social media stuff. And then we'll have this full waitlist challenge that'll be up. And of course, there's a place for questions. And then if you need to contact me directly, my contact, I believe, is on the website as well.
Perfect, man. This has been a super educational episode. Just learning about the platform that you're all building, learning about the blockchain for the first time from somebody who does it, who's involved in it. So I think the explanation we got of that was very easy to understand, as well as like just what people should be looking for. This is not really a conversation people have. A lot of people say invest in REITs or this platform, that platform, but nobody does what we did today, which is like all the things you need to consider before you put your money out. So, I think this was great, and I'm excited, man. I can't wait to see, the launch and just how things are over time. Maybe in 5 years or so, or even sooner, we'll be talking about your big exit.
Oh, there won't be an exit.
Okay.
Oh no.
You're holding?
Oh, Kopa is going to be like, when I said 100 years, that wasn't a joke.
Okay.
No,
all right.
We're going to eventually we'll launch our own token, that will allow people to buy into actual Kopa itself. We
Got
have
you.
we have a couple things to do to make sure that the SEC is okay with it. But no, this is I want this to be owned by everyone.
Okay.
The wealth that's going to be made is going to be made for everyone. This is not a get rich. That's not what it's for. Money will be made, but it's going to be made because all of us are owning stuff together, and owning the token will also mean lower fees, so that it's much more inclusive. But thank you. Yeah, I'm really excited. Like it takes time to make sure things get it right, but really excited for it to happen.
Absolutely, man. I appreciate it. And I appreciate you clarifying that and just talking about the different approach that you all have and what you're trying to do for the long term. So appreciate that too, man.
100%. And the only other thing is just when you were saying before about what people will just say to do, like invest in REITs or do this or do that. The number one thing you could do as an investor and as a person in anything is to ask why. And that's been my life, right? But like, so you do this, but is it because there's no other option? Do you do this because it's a smart thing to do? Do you do this because a lot of times people are telling you what to do, actually don't have no idea themselves. Or they're just saying, here's the best of what it is. And you have to play the game as it is. But if you understand why someone's telling you to do something, it makes a big difference. And so from our side, with us, we want people to ask us why. We're actually very proud of it. But if others, whenever others start clamming up and saying they can't give you a reason, that's your answer. And so whether it's REITs or funds or Kopa or anything else, when you start seeing people get shady on the side and get quiet on you, that's your answer.
Definitely appreciate that, man. Appreciate it. And thank you to everyone for listening to another episode of the Black Real Estate Dialogue. If you're on YouTube, make sure you like, make sure you subscribe, all those good things. Leave a comment. If you're on the audio side, leave us a 5-star rating and review. Congratulations, you made it to the end. I appreciate you, and I look forward to hearing from you soon. What's up, y'all? Sam here from the Black Real Estate Dialogue podcast. Thank you so much for watching another episode. Definitely take a moment to subscribe. Make sure you like this video. Also, visit our website, blackrealestatedialogue.com, and follow on Instagram @Black Real Estate Dialogue. Talk to you soon.